Well, let's just jump into some of these reports, Matt. Starting with this one from Moody's, and there's tons out there. I mean, I think I've seen lists of dozens of reports that financial institutions are putting out. We're just highlighting a handful that I think are more relevant to the multifamily industry, kind of real estate, kind of sum things up. But let's start with this. Let's start with this Moody's piece. It came out recently, and Moody's is not dedicated to commercial real estate solely, or especially multifamily. They're covering a wide range of asset classes and alternative investments, including commercial real estate. But just to kind of sum up, and this came out on December 30th, apartments struck a balance, office demand plummeted, and retail remains flat. So now they didn't mention industrial, but apartments are in a seemingly good spot relative to the rest of the economy and other commercial real estate asset classes. Now they did a quick little bullet point summary of summing up the year and where things are. And I think most people understand the stock market's down, interest rates are up, housing demand is down with high interest rates, and we've had some negative rent growth and absorption over the last several months in the multifamily sector. But Matt, what are some of your takes from the Moody's piece? Anything that pops out?
Yeah, just to come back to the economic context just for a second, there were a few, and we talked about a lot of these last week. But a couple of new points that this one made that I'm sure aren't really a surprise to anyone, but are worth mentioning, is that supply chain stress has eased up and gas prices are, at least for now, down from the year's high point. It's hard to conceive of a supply chain that's not in a tangled crisis, but it seems like things are getting untangled. And I remember hearing, this was like even a couple weeks ago, that one of the supply chain cost trackers that was made during the pandemic, that's actually showing that we're closing in on normal, whatever normal means. But it's not as much of a problem as it is now. I that's not to say that it is that previous supply chain stress is not working its way through the economy through whatever, construction projects or, business balance sheets, whatever it is, like that's going to have a lagging effect. But on the ground level, it seems like it has eased up. I think that there's a Chinese COVID outbreak that may affect this, may not, but at least for many indicators, it is supply chain.
It's better than it was.
Yes, exactly. Secondly,
it's
labor
better than it was. Yeah. Well, just real quick before we move off supply chain, just a quick point is that I think some of the pandemic related bottlenecks, they've been easing, but I think the longer term story is the restructuring of global supply chains to make them more geographically diverse and resilient. And so some of that is going to be onshoring here in the United States. But it's more diversification where companies saw 100% of their manufacturing coming out of China, and then it shrieked to a halt during COVID. And that's maybe it's not bringing everything back to the United States, but maybe they only have 40% of their manufacturing in China, and 20% in Vietnam, and another 20% in Mexico, and 10 in the United States, and 10, you're in several different markets, and that can be more complicated. But I guess what I keep coming back to, Matt, is the world is still flat, and the advantages of global capitalism and being able to get the best price, I don't think are going away and can't be ignored. Now, I think that we're going to be in a more mature global economy because we understand the risks of supply concentration. So I think that's going to be more inflationary over a medium to longer term period. Because it may be a little bit more expensive to manufacture some of your goods in the United States or other countries, or just may cost more resources to have multiple manufacturing operations, but you don't get the bottlenecks maybe at the next pandemic in 100 years, or whatever the next black swan trade war, whatever it could be.
That's a good point. Planning for a 100-year event is it's a little weird.
We're always fighting, we're usually fighting the last war, but it's probably not a bad thing to.
Oh yeah, for sure.
So enough supply chains.
Yeah, and then the next point, and you can kind of see it down here, is the idea that labor. Maybe there has been some tech layoffs, but I think that the bigger story is that it has not yet imploded. It's almost like people are waiting for bigger layoffs than there already has. And I do think that it is notable that labor has been sustainably high. There are other sources that we'll go over here that will talk about the importance of job growth to a particular multifamily market, but job growth in general is good for the economy. It's good for the multifamily market. And it doesn't seem like we are facing something horrible in 2023 when it comes to the labor market. Maybe a little bit of stagnation, maybe things
that's what people keep coming back to. Yeah. It's like, how are we in a recession? And we've talked about that we could be in a recession, or that we were in a recession, but the fact that the labor market is still so tight and unemployment is so low, and we are seeing wage increases. How do you call yourself in a recession? That being said, anecdotally, there are certainly some high-profile layoffs in the tech sector, in the financial sector, that make people think that maybe we're going to see more layoffs further in 2023 if we really have a recession, and that maybe we're early. But man, we're starting from such a low place, and again, that's speculation. Could it happen? Absolutely.
Yeah, that's a good point, and it's almost like if I'm worried about something, it seems like there could be more layoffs. These could spread. It seems much more worrying on that side of things, rather than like a situation where the labor shortage exacerbates and becomes kind of a wage price spiral. It seems like we're tipping more towards a bad employment situation rather than a kind of scary inflation situation. But that's my pessimistic outlook. Yeah. I don't think we're there yet, though.
We should be, and no, I agree. I don't think we're there yet. And another factor that's going to cut both ways is that a lot of wage increases were triggered at the start of the year. A lot of individuals had pay increases that would go into effect January 1, or some of the new minimum wage laws that were passed went into effect January 1. And so we're going to see, a little spike in, total, wage growth in the start of 2023. How inflationary is that, or if it's on the margins, I think it's yet to be seen. But I think we're still going to see a tight labor market. But some of the cost of labor also get to a point of where employers are going to have to start making some strategic decisions of, who they really need and who maybe they don't need. And then also it's how much of that is in preparation for a potential downturn versus we're in the downturn, we have to reshuffle. Because if looking back, if you're in a recession, you'd love to have said, well, we should have gotten rid of, X percentage of our workforce a quarter or two ago and been able to save cash. But, you don't have the luxury of going back in time. And so our CEOs, assuming there's going to be a recession and making some of these decisions in anticipation of the downturn, which makes the downturn that self-fulfilling prophecy that we always talk about.
So I thought about that, and I put some of these ideas in a later part of the notes. But there does seem to be this kind of like bunker mentality, whether it's driven by fear or whether it's driven by like the need to kind of prepare for the future. But I think that some of this bunker mentality, yes, it's uncertainty, and they don't want to, they don't want to bet on an uncertain future, but it could also be interest rates are making it harder to make those predictions in the first place. It is driving people to be less expansionary and more, stick to what you know. And so as a discrete and tangible effect on the economy, that seems a little bit more persuasive than fear. Although, high interest rates makes fear a very easy to act upon, I guess.
Yeah. No, it is just that uncertainty. And it's also with interest rates moving mad, it's changed the discount rate on how, businesses are valued. And that's hitting the tech sector the hardest. And kind of getting back to a similar idea is that, you have companies like, Tesla that are down 70%, tech companies all across the board. I mean, if you're, if you're a, Apple or Microsoft, maybe you're only down 30 to 40%. The tech companies are really reeling, and so part of that is they're looking at their new valuation and how do these CEOs and CFOs, how do they climb back to getting a little bit of a better valuation? How do they get that cost per share up? And one way to do it, just like no different in commercial real estate, you got to increase your net operating income and your revenue. And one way to do that is to increase net operating income is to decrease expenses. And for a tech company that has a huge payroll, paying people hundreds of thousands of dollars for maybe a half a week's worth of work, or very kind of cushy jobs that probably some of them weren't 100% necessary, and they're saying, well, look, we have to reduce our payroll, and because their shareholders are looking at them saying, hey, we're down 70%, you got to do something. Investors see, okay, they're reducing their payroll, they're going to have wider margins. That should be reflected in the stock price itself. So I think some of these layoffs are really trying more financial engineering that, and also probably a little bit of, if your company's down 70%, I would feel like it's a recession.
Yeah.
And that's what I would communicate. And you certainly don't want to say it's my fault or something the company did is why we're down 70%. You'd much rather say it's macroeconomic forces that have caused this.
Yeah.
So.
And then finally,
anything else on the macro on Moody's?
Yes. There's one more thing in it, and it is kind of in the same vein, is that average credit card debt is inching upward as an indicator that households are increasingly cash-strapped amid soaring inflation. This is an interesting, and I've heard other sources talk about how all of that wealth that we've gathered during the boom times post-pandemic or late pandemic, that's kind of eroded largely. And I think that this is a data point that shows that we've kind of drawn on all the wealth that we had saved up, and maybe we're hitting a point where things are starting to hurt a little bit. That's a kind of a good news for inflation, that people are starting to feel pain, but it creates more risk, more vulnerability, and that's we don't want an implosion. So it's another worrying and uncertain sign for the future. Great.
Yeah. Matt, my one comment on just the beginning of this report is that, while they did have some figures near the top, I feel as though that it was lacking some citations and data that come to the bottom of that list. Like, I would have loved to get some actual data on average credit card debt. It's inching upwards. Well, okay, inching. What does that mean? On the labor comment, that's just a comment to Moody's, but being a little critical. But anyway, we digress. Let's go on. Let's talk about multifamily commercial real estate, what Moody's has to say.
Yeah, let me just run through the commercial real estate, and then we can stay on multifamily just for a second. So their take on CRE, and again, I'm going to put multifamily last. So office. Demand is weaker, both from steadier remote working policies and lower corporate profits. Demand went from 3 million square feet in Q3 of 2022 to negative 7.13 million square feet in Q4. Again, what you said about the figures is right. I would take these figures with a little bit of a grain of salt and kind of follow it up. But the general story is that demand went down. I think the economic factors as well as the working arrangements, those are both kind of converging now and resulting in lower demand for office. Retail is a little bit of a brighter spot. It's kind of interesting because they do note that the pandemic did keep people at home, and it did lead to a big rise in e-commerce that kind of took away from brick and mortar retail. But retail real estate did not fall as precipitously as it did in the wake of the 2008 financial crisis. Consumer spending is at healthy levels, and neighborhood and community shopping center net absorption was up 44% in Q4 as compared to last quarter. So it's pretty good. And this is the story that we have been seeing. Office has significant challenges and probably is going to be transformed really in the next few years. Retail had challenges, but not transformative, completely disruptive challenges. It may emerge from this a lot healthier than what would have been expected for a pandemic that kept people at home for so long.
Yeah.
And then now to multifamily. It leads off with this idea that national multifamily supply and demand both cooled. They say to their lowest level in 2009. But Spencer, you have sagely noted that some of the exact figures behind this cooling may be off, and it deserves to be corroborated, I guess, with other sources.
Yeah. Well, when I was going through the report, and they mentioned that I'd love to get comment from Moody's, but basically that total construction delivery and net absorption only reached 100,470 units and 135,472 units for the year respectively, the weakest record over the past decade. Now we were on track at one point, Matt, to deliver over 500,000 apartment units in the United States. And it was widely reported that we were falling short of that 500,000 plus number. I even saw reports it was going to be in the $600,000 range, 600,000 unit range. So this 100,000 unit, just being 20% of what was forecasted, and well below, I guess, for some of the reports that we've covered on the Gray Report that were more in flux. I bet the number is going to be coming out somewhere in the mid 300 to 400,000 unit delivered range across the country. So 100,000 units is significantly below what I was anticipating, and so I don't believe the number is correct. And I believe we have some figures from Berkadia and several other sources that point the number at much higher, still well below what was anticipated. So Matt, you said this very correctly earlier. The story, the narrative on this Moody's article is correct, but some of the numbers, I almost wonder if they grab some of these numbers from a market or a region or a quarter.
That makes a lot more sense,
because they're not, they couldn't be national yearly numbers. And I would even say even in that office section, they were saying that what was 1 million square feet delivered or something. That's like a build. That's a large building, or a couple large buildings.
Yeah.
And so to me, and again, anecdotally, I think we should look into those numbers. And so again, not that this Moody's article doesn't have good narrative, it has some good information, but it's one of those cases where you really need to just take all the information with a grain of salt. And I'd recommend on any of these reports, take them with a grain of salt. I mean, now you've covered and we're tracking, the discrepancies in these reports from whether it's a rent growth or some of the other KPIs, and some because they have different methodologies, and that's fine. But this would be a discrepancy that is beyond a variance in methodology and much more just looking at the wrong data set, I think.
Yeah, that's what it did seem like. It was not as robust as other places. And again, Moody's is covering all of these sectors, and it's a little bit more maybe of a mass market of investors than people that are specifically multifamily focused. But even so, so it was strange. Their information on the specific markets, they had the biggest winner for multifamily markets was Knoxville. And then the biggest loser is Memphis, both in Tennessee. I just didn't think, Knoxville had 19.3% year-over-year rent growth, and Memphis is at negative 0.7%. I don't know. It just seems weird to me that there's such a difference. Now, I don't know that much about Tennessee multifamily. I was just, the general story is something that I'm more interested in. And their general story noted that a lot of the markets with falling rents were pandemic darling markets. I can get behind that. It's just when you dig a little bit of the details, it's a little different.
Yeah, I agree. I mean, this is the first time I've seen, I think, Seattle in a top spot for effective rent growth. Now that it is effective rent growth, not market rent growth, which we're often looking at market rent growth. But yeah, it's a little bit of a different list than what we're seeing across other sources, I would say.
Yeah.